Methods used to finance terrorism. Terrorist financing refers to the collection, movement, storage, and use of funds intended to support terrorist organizations, activities, or individuals. Unlike traditional money laundering, terrorist financing may involve funds derived from both legal and illegal sources. Common methods include charitable organizations abused for fundraising, donations from sympathizers, cash smuggling, trade-based schemes, fraud, kidnapping for ransom, narcotics trafficking, extortion, and misuse of informal value transfer systems such as Hawala. Terrorist groups increasingly exploit digital payment systems, prepaid cards, crowdfunding platforms, cryptocurrencies, and online fundraising campaigns. Because terrorist operations can require relatively small amounts of money, detecting suspicious activity often presents significant challenges for financial institutions. Terrorist Financing Risk Model. The CAMS framework emphasizes a risk-based approach to identifying terrorist financing. Key risk indicators include unusual international wire transfers, transactions involving high-risk jurisdictions, rapid movement of funds through multiple accounts, use of non-profit organizations with limited transparency, and structured deposits intended to avoid reporting requirements. Terrorist financing networks often seek anonymity through intermediaries, shell companies, and cash-intensive businesses. Financial institutions must implement customer due diligence, enhanced due diligence, sanction screening, and transaction monitoring to identify these threats. The terrorist financing model typically involves 3 stages: fundraising, movement of funds, and deployment of funds for operational activities, recruitment, training, or attacks. Money laundering through banks and depository institutions. Banks and other deposit-taking institutions remain among the most frequently exploited channels for money laundering due to their central role in the financial system. Criminals use deposit accounts, wire transfers, loans, cashier's checks, correspondent banking relationships, and electronic payment systems to move illicit proceeds. Common methods include structuring deposits below reporting thresholds, commingling illicit and legitimate funds, funnel accounts, smuffing, cash-intensive business deposits, and rapid transfers through multiple accounts. Criminals may also use shell companies and nominee account holders to disguise beneficial ownership. The objective is to create layers of transactions that conceal the origin and ownership of criminal proceeds. Bank laundering model: placement, layering, and integration. The classic money laundering model within banks consists of 3 stages: placement, layering, and integration. During placement, criminals introduce illicit funds into the financial system through cash deposits, monetary instruments, or business revenues. Layering involves transferring funds through multiple accounts, jurisdictions, or financial products to obscure the audit trail and separate the money from its criminal source. Integration occurs when laundered funds re-enter the legitimate economy through investments, business acquisitions, loans, or luxury purchases. Banks combat these risks through Know Your Customer (KYC) procedures, customer due diligence, suspicious activity reporting, transaction monitoring systems, and enhanced due diligence for high-risk customers and jurisdictions. Money laundering through insurance companies. Insurance products can be attractive tools for money laundering because they often involve large financial transactions and may contain investment features. Criminals may purchase life insurance policies using illicit funds and later surrender the policies for legitimate-looking proceeds. They may also overfund policies, make excessive premium payments, transfer ownership to third parties, or use policies as collateral for loans. Single premium life insurance products and investment-linked insurance contracts are particularly vulnerable because they allow substantial sums to enter the financial system quickly. Fraudulent claims, policy cancellations, and policy loans may further facilitate the movement and disguise of criminal proceeds. Insurance laundering risk model. The insurance money laundering model generally involves purchasing, layering, and redemption. In the purchasing phase, illicit funds are used to acquire insurance products. During layering, ownership changes, premium adjustments, beneficiary modifications, or transfers between related parties create complexity and obscure the source of funds. Finally, the policy is redeemed, surrendered, or borrowed against, generating proceeds that appear legitimate. Red flags include unusual premium sizes, early policy cancellations, third-party payments, inconsistent customer profiles, and reluctance to provide source of funds information. Effective controls include customer identification, beneficial ownership verification, transaction monitoring, and ongoing review of policyholder activities. Money laundering through broker-dealers. investment advisors, and capital markets. Broker-dealers, investment advisors, and securities markets provide criminals with numerous opportunities to move and disguise illicit wealth. Money launderers may purchase and sell securities, bonds, mutual funds, derivatives, futures contracts, and other investment products to create complex transaction trails. Common methods include wash trading, market manipulation, mirror trading, rapid purchases and sales without economic purpose, and the use of nominee accounts. Criminals may also transfer funds through brokerage accounts in multiple jurisdictions, exploiting differences in regulatory oversight. Because capital markets facilitate large volumes of transactions, suspicious activity can be difficult to detect without sophisticated monitoring systems. Capital Markets Laundering Model. The capital markets laundering model focuses on account establishment, transaction layering, and asset liquidation. Criminals first open investment accounts using false identities, shell companies, or intermediaries. Funds are then layered through multiple trades, transfers between accounts, international securities transactions, and purchases of highly liquid financial instruments. Finally, assets are sold and proceeds withdrawn as apparently legitimate investment gains. Key AML controls include customer due diligence, beneficial ownership verification, monitoring unusual trading patterns, identifying suspicious third-party transfers, and reporting unusual transactions to financial intelligence units. Effective oversight helps protect market integrity while reducing the risk of financial systems being exploited by money launderers and terrorist financiers.